Hello and welcome. Before we start, please subscribe to our YouTube channel for news and updates. US markets finished the first full week of December modestly higher, with mega cap tech once again doing the heavy lifting even as bond yields moved up. S&P 500 up about 0.3% for the week. Nasdaq Composite gained roughly 0.9% for the week. Dow Jones Industrial Average added about 0.5%. Sector performance was mixed. Information technology and communication services posted gains, while defensive areas such as utilities and healthcare lagged. Investors leaned back towards cyclical growth and AI beneficiaries, even as they remained selective. Bond market yields push higher. The Treasury market had a difficult week, with longer dated bonds selling off and yields moving higher. The 10-year Treasury finished around 4.14% on December 5th. Rising yields came despite rising expectations for a Federal Reserve rate cut as global influences, particularly speculation of Bank of Japan policy shifts, pushed global yields higher. Key drivers: economic and geopolitical backdrop. 1. Inflation. Data and Fed expectations. Fresh inflation readings continued to support the narrative that price pressures are cooling. Markets broadly expect a Fed rate cut in 2026, helping support equity prices. 2. Mixed economic data. Manufacturing remained soft, with trade friction still weighing on activity. However, the broader U.S. economic picture looked consistent with a soft landing scenario rather than a sharp contraction. 3. Global central bank dynamics. Speculation that the Bank of Japan may move toward tightening contributed to higher global yields, putting pressure on treasuries even as domestic Fed expectations remained dovish. Looking ahead, opportunities and concerns for the week of December 8th. Opportunities 1. Fed meeting and policy messaging. The upcoming Federal Reserve meeting is the key event of the week. A confirmation of dovish policy leanings could support equities, particularly growth and rate-sensitive areas. 2. Earnings and corporate guidance. New earnings reports will give investors insights on margins. 3rd, year-end repositioning. Portfolio managers behind benchmarks may look to add risk into year-end if markets remain stable. Concerns 1. High rate cut expectations. Market pricing already assumes aggressive Fed easing. Any hawkish signals could pressure equities, particularly high valuation tech. 2nd, bond market volatility. The recent sell-off in long-dated treasuries remains a risk. Higher yields could weigh on financing conditions and equity valuations. 3rd, geopolitical and global growth risks. Trade frictions, global tensions, and manufacturing weakness remain notable risks. How to position. Investors should remain invested but selective, focusing on quality growth and profitable technology companies. High-quality fixed income remains a stabilizer, though interest rate sensitivity persists. Volatility related to the Fed this week may offer opportunities to rebalance portfolios and ensure alignment with long-term objectives. Stay calm, stay invested, and let us know if we can assist you further. Visit mraadvisory.com to learn more and schedule a conversation with one of our advisors. Thank you for listening. For additional information, please visit our website